Welcome. Every year, thousands of students walk into their final accounting exam, sit down, and immediately get one of the very first, most basic questions completely wrong. This is the June 2024 Examiner Report. It highlights exactly where students slip up right at the start of the paper. Look at the notes for question 2. A huge number of candidates read the word accounting and guessed that it means the everyday recording of financial transactions. But that is incorrect. To keep these definitions straight, it helps to think of a basketball team. There is a massive difference between the scorekeeper sitting at the desk and the head coach pacing the sidelines. One person tracks the raw points as they happen, while the other uses those numbers to design a winning strategy. Recognizing who does what is the key to passing this section of the exam and understanding how managers evaluate a company's performance. Let's start with the person at the desk. In business, the scorekeeper is the bookkeeper. Bookkeeping is the detailed, day-to-day recording of every single financial transaction a business makes. If a shop buys fresh inventory, pays the monthly electricity bill, or issues a cash refund, the bookkeeper writes it down. It is highly administrative work. The main requirement is absolute pinpoint accuracy so that no penny is left unaccounted for. They log these transactions systematically into initial lists called books of prime entry, and then organize them into specific categories within the business's ledgers. There isn't any deep analysis happening here, but without the scorekeeper's perfect raw data, the rest of the business is flying blind. Now we look to the sidelines. The accountant is the head coach, and their job only really begins after the bookkeeper has collected all that raw data. The accountant's first major task is taking those thousands of detailed ledger entries and condensing them into formal summaries, known as financial statements. This diagram shows how that data flows. A chaotic pile of daily receipts goes into the funnel, and it emerges as a single clear bar chart showing profit or loss. The exam expects you to identify this specific step. Accounting measures these profits and losses. The accountant studies this chart to diagnose business health, look for trends, figure out cash dips, and decide what changes to make. They then hand these insights over to the people who need them, the store managers, the owners, or outside investors, so they can make informed choices. The scorekeeper mechanically records the past. The coach analyzes those records to actively shape the future. Both of these roles share one strict boundary. They only care about money. This is known as the money measurement principle. It means an event is only recorded in the business's books if its value can be reliably measured in cash. Let's say a company hires a brilliant new store manager, or a rival launches a highly competitive new product across the street. These are massive events for the company. Because you cannot put a strict objective dollar amount on the value of a good manager or the threat of a rival, they are completely excluded from the financial records. This creates a strict limitation you need to be aware of. Financial statements give you an incredibly accurate mathematical reality, but they ignore the unquantifiable human context of the business. Let's go back to that multiple choice question from the start of the video. Bookkeeping is the clerical, mechanical recording of daily financial data. Accounting is the analytical, measuring, summarizing, and strategic decision-making based on that data. As long as you remember the difference between the scorekeeper and the coach, you won't fall for that syllabus trap again. If you are ready to see where your baseline knowledge stands right now, head over to www.studybuddy.tech and take our free diagnostic assessment. Nailing down these definitions ensures you start your exam with total clarity, giving you a solid foundation for the more complex units ahead.